There's a guy in Boston named Daniel. He's 34. He works in IT, makes decent money, and has been meaning to figure out investing for 3 years. He has a folder on his desktop called Finance Stuff that has one PDF in it from 2021 that he's never opened. Every January, he tells himself this is the year he actually starts. Every April, tax season reminds him that he hasn't. He's not lazy. He's not bad with money. He's just waiting until he understands enough to feel like he's doing it right. Here's the thing about Daniel. He will never feel ready. And the painful irony is that the strategy that would actually make him a millionaire requires him to understand almost nothing. It requires no stock research, no earnings calls, no financial news, no deciding between this company and that one. In fact, the less he does, the better it works. The portfolio that turns $0 into $1 million doesn't care if Daniel ever opens that PDF. This video is about that portfolio, how it works, why it works, what it actually looks like in an account, and the math behind why the people who do the least with it end up with the most. My name is Sachi, and I make personal finance videos for people who are tired of feeling like everyone else got a rulebook they never received. If that's you, subscribe, because today we're building $1 million portfolio from scratch, and not a single step involves picking a stock. Quick disclaimer before we get into it. I'm not a financial advisor, and this isn't financial advice. This is me walking you through what the data actually says about long-term wealth building for regular people, the kind of information that used to live behind expensive advisors and paywalls. Now let's get into it. First, let's kill the idea that investing requires skill. This is the belief that keeps most people out of the market longer than anything else. The idea that you need to know something, that there are people who've cracked the code, who know which stocks to buy, who can read the market well enough to get out before it crashes and back in before it recovers. That investing is a skill, like surgery or chess, and until you develop that skill, you shouldn't touch it. Here's what the data says. Professional fund managers, people whose entire career is picking stocks, who have teams of analysts, access to proprietary research, and decades of experience, the majority of them underperform a basic index fund over any 15-year period. Depending on the study and the time frame, that number is somewhere between 80% and 92% of active managers. Not retail investors trying to pick stocks on a lunch break, professionals, with every advantage imaginable. S&P Global releases a report called the SPIVA scorecard every year. In the most recent 20-year data, over 94% of large-cap active funds underperform the S&P 500. After fees, 94%. Meaning if you randomly selected a professional stock picker and a basic index fund and ran them side by side for 20 years, the fund manager beats the index less than 1 time in 10, and you were waiting to feel qualified before you invested. This isn't a knock on fund managers, it's actually a structural problem. When you're managing billions of dollars, you can only buy so many things without moving the price. You're required to diversify. You're forced to act. Even when doing nothing would be smarter. The market is efficient enough at the large cap level that genuine edge is almost impossible to sustain. The index doesn't have those problems. It just owns everything and goes to sleep. So the premise of this video isn't some optimistic claim. It's backed by 20+ years of consistent evidence. Not picking stocks isn't the safe, boring, I don't know what I'm doing move. It's the move that beats most people who do know what they're doing, what the portfolio actually is. Let's make this concrete. The $1 million no-stock picking portfolio is built on index funds, specifically low-cost index funds that track broad market indices. The most common version is a simple 3-fund portfolio. Some people run it with 2, some run it with 1. All of them beat the majority of actively managed funds over the long run. Here's what it looks like. Fund 1 is a total U.S. stock market index fund, something like Vanguard's VTI or Fidelity's FZROX. This fund owns a piece of every publicly traded company in the United States, roughly 3,500 to 4,000 companies. Small ones, medium ones, large ones. When the U.S. economy grows, this fund grows. When companies make money, you make money. You own all of them, so you don't need to predict which ones win. Fund 2 is a total international stock market index fund. VEU, VXUS, FZILX. There are a few options. This gives you exposure to developed and emerging markets outside the US. Europe, Japan, Canada, South Korea, India, and hundreds of others. Some of the biggest wealth-building decades in history have happened outside the US. This fund makes sure you don't miss them. Fund 3 is a bond index fund. BND, FXNAX. Bonds are essentially loans you make to governments or corporations in exchange for interest payments. They're less volatile than stocks, which means when the stock market drops 30%, your bonds don't fall nearly as much. Bonds are the shock absorber in the portfolio. They don't make you rich. They keep you from panicking and selling when stocks get ugly. That's the whole portfolio. 3 funds. You buy them once, set contributions to auto-draft from your paycheck or bank account, and you don't touch them. The question isn't which stocks to pick. The question is just what percentage of your money goes into each bucket, how to split it up. The classic split for someone in their 30s or early 40s is 80% stocks, 20% bonds, or even 90-10 if you have a long time horizon and strong nerves. The further you are from retirement, the more you can afford to lean into stocks, because you have time to ride out any crashes. A common starting template: 60% US stocks, 30% international stocks, 10% bonds. As you get closer to retirement, you gradually shift more toward bonds. Less growth, more stability. Some people simplify this even further with a single target date fund. You pick a fund with the year you plan to retire, like Vanguard Target Retirement 2055, and the fund automatically adjusts the mix for you over time. Heavier in stocks when you're young, progressively more bonds as 2055 approaches. One fund, one decision. Done. Daniel, from the beginning of this video, he needs one fund and an automatic monthly contribution. That's it. He doesn't need to understand international market capitalization weighting or duration risk in bond ladders. He needs to click 3 buttons and leave it alone. Now the math, because this is where it stops being theoretical. Let's say you're 30, you start with nothing. You invest $400 a month into a low-cost index fund, total US market, broad exposure, expense ratio of about 0.03%. The S&P 500 has returned roughly 10% per year on average over the past 100 years. After inflation, that's closer to 7% in real terms. Let's use 8% to be conservative but not pessimistic. $400 a month at 8% annual returns over 35 years, you reach retirement at 65, gives you approximately $1.03 million. $1 million. From $400 a month. That's roughly $13 a day, the price of a lunch, and you never had to research a single company. Let's run a few other versions. Start at 25 instead of 30 with the same $400 a month. At 65, you have $1.68 million. 5 extra years adds $650,000. That's the compounding effect. Early contributions have 40 years to double, triple, and double again. Start at 30 but increase to $600 a month. Maybe after a raise or paying off a car loan, you hit $1.54 million by 65. Start at 35 with $400 a month. You land at about $680,000 by 65. Not a million, but still more than 80% of Americans retire with. And if you bump contributions to $600 a month at 35, you're back over $1 million. The single most powerful input in this formula isn't picking better investments, it's time. And the second most powerful input is consistency. Contributing every single month, whether the market is up, down, or doing something completely inexplicable. The fees nobody talks about until it's too late. Here's a number that will change how you look at every investment product forever. Expense ratio. An expense ratio is the annual fee a fund charges to manage your money. It's taken automatically, you never write a check for it, which is exactly why most people don't think about it. But the difference between a 0.03% expense ratio and a 1% expense ratio is enormous over time. Take $10,000 invested for 30 years at 8% annual returns. In a fund charging 0.03%, which is what Vanguard, Fidelity, and Schwab charge on their index funds, you end up with about $99,400. In a fund charging 1%, which is what many actively managed mutual funds still charge, you end up with about $74,400. That's $25,000 gone, not to market losses, not to taxes, to fees, on a starting balance of just $10,000. Scale that up to a career's worth of contributions and you're talking about $100,000 to $300,000 in lost wealth, paid quietly to a fund manager who, statistically, is underperforming the index anyway. The three big low-cost providers, Vanguard, Fidelity, Schwab, offer index funds at expense ratios between 0% and 0.05%. Fidelity's FZROX and FZILX have a 0% expense ratio. Nothing. Free. This matters. Index funds aren't just better performing, they're cheaper. The combination of better returns and lower fees is why the math keeps landing in their favor decade after decade. Where to actually hold the portfolio. This is the part most people don't think about, and it costs them real money. It's not just about what you buy, it's about where you hold it. Because the same investment in different account types is taxed completely differently. If you have access to a 401k through your employer, that's your first stop. Contributions go in pre-tax, which means you're investing dollars the government hasn't taken yet. If your employer matches contributions, say 4% of your salary, that matches an instant 100% return on those dollars before the market does anything. No index fund on earth can give you a guaranteed 100% return. Not maxing the match is one of the most expensive financial mistakes a working person can make. For 2026, the 401k contribution limit is $23,500 if you're under 50. If you can't hit the full limit, aim for at least the match, then keep going as your income grows. After the 401k match, a Roth IRA is the next best option for most people. The contribution limit is $7,000 per year in 2026. The money goes in after tax, you've already paid income tax on it, but everything that grows inside a Roth comes out completely tax-free in retirement. No taxes on the growth, no taxes on the withdrawals. If you're investing in an index fund that grows at 8% for 30 years inside a Roth IRA, every dollar of that growth is yours. The IRS gets none of it. The math on a Roth IRA held over a full career is staggering. A 25-year-old who maxes a Roth at $7,000 per year until 65, with no employer match, just a plain index fund, ends up with about $1.9 million. All of it tax-free. The total amount they contributed over 40 years was $280,000. The other $1.62 million was the index fund doing what index funds do when you leave them alone. Once the Roth IRA is maxed, go back to the 401k and push contributions higher. And if you have money beyond that, a taxable brokerage account works fine for index funds too. The tax treatment is less favorable than a Roth, but it still beats paying 1% in fees to someone who underperforms the market. The one thing that actually destroys this portfolio, it's not a market crash, it's not recession, it's not inflation, rising interest rates, or anything that gets covered on financial news, it's you. There's a research firm called Dalbar that has been measuring the gap between what the market returns and what investors actually earn for over 30 years. Their findings are consistent and brutal. In 2024, the S&P 500 returned just over 25%. The average equity fund investor earned 16.5% in the same year. Same market, same funds in some cases. 8.5 percentage points of underperformance because people bought late, sold early, chased something that had already run up, and switched funds at the wrong time. Over 20 years, Dalbar data shows the average investor underperforming the S&P by more than 1 percentage point every single year. Compounded over a career, that's hundreds of thousands of dollars. Here's the thing about index funds, they only work if you let them work. The fund doesn't care when you panic. It doesn't care about the news cycle. It just holds every company in the index and collects dividends while you stress eat and check your account balance at 2 a.m. But if you sell when it drops 20% and buy back when it recovers, which is what human psychology pushes almost every person to do, you turn a great strategy into an average one. There's a statistic that makes this viscerally real. If you had invested $10,000 in the S&P 500 in January 2005 and just left it alone through everything, the 2008 financial crisis, COVID in 2020, the 2022 rate hike sell-off, you would have ended 2024 with approximately $72,000, 7 times your money. If you missed only the 10 best trading days in that entire 20-year stretch, 10 days out of roughly 5,000, you end up with about $33,000, less than half. And here's the part that makes this statistic genuinely mean something. 7 of the 10 best days in the market happened within 2 weeks of the 10 worst days. The recovery comes right after the crash. The people who sold during the scary part missed the entire bounce back. The strategy for avoiding this isn't discipline, it's automation. Set up automatic monthly contributions, set them and forget them, turn off market notifications, stop checking your balance during news events. The less friction there is between your paycheck and your index fund, the less opportunity there is for your brain to make an expensive decision. The rebalancing question. One thing the passive portfolio does require is occasional rebalancing, maybe once a year. Over time, if stocks do well, your portfolio drifts. Maybe you started at 80% stocks, 20% bonds, and after a strong year in equities, you're sitting at 88 to 12. Rebalancing means selling a little of what's grown and buying a little of what hasn't to get back to your target allocation. This takes about 20 minutes once a year. Some brokerages do it automatically. If you're using a target date fund, this is handled for you. The fund rebalances itself. You do nothing. The rebalancing process is also where automatic contributions help. If you're contributing monthly, you can direct new money toward the underweighted asset class instead of selling anything, which is more tax efficient in a taxable account. What building to $1 million actually looks like month by month. Let's walk through this the way it actually unfolds for a real person. Month 1. You open a Roth IRA at Vanguard, Fidelity, or Schwab. Takes 15 minutes. You fund it with whatever you can. $100, $500, $1,000. You buy VTI or FZROX. You set up a recurring monthly contribution from your bank account. Month 6. The market has done something. Maybe it's up, maybe it's down. Your balance is different from what you put in. You do nothing. Year 1. You've contributed through 12 months. You check your balance once. You keep contributing. Year 3. There's probably been a market event of some kind. A 10% pullback, a correction, something that made headlines. Your balance dropped for a few weeks. It came back. You kept contributing through it. Year 10, your account has grown meaningfully. The contributions you made in year 1 have had a decade to compound. You've started to see what the math actually looks like in real numbers, not projections. You've increased contributions twice because your income grew. Year 25 to 35, this is where the compounding hockey stick appears. The growth in the final decade of the portfolio often equals or exceeds the total amount you contributed over your entire life. This is the phase most people don't see because they never get here. Either they never started or they sold something at some point and broke the chain. The version of this for people who feel behind. Maybe you're reading this at 40 and you don't have much saved. Maybe you have some, but not what you feel like you should. Here's what the math says. A 40-year-old with nothing who invests $600 a month at 8% returns has about $1.02 million by 67. That's the Social Security full retirement age for most people born after 1960. Still $1 million. Starting later just means contributing more per month, which is often feasible at 40 because income tends to be higher than it was at 25. The mistake people make when they feel behind is doing nothing because they're overwhelmed, or trying to make up for lost time by taking bigger risks, picking individual stocks, chasing high-return investments, trying to compress a 30-year wealth-building strategy into 5 years. That approach fails most of the time and fails expensively. The boring answer is still the answer. Consistent contributions to low-cost index funds held for as long as you can hold them. The second mistake is underestimating what's already there. If you have $30,000 or $50,000 saved in a 401k that's sitting in a money market fund or a default savings option that isn't invested properly, that money hasn't been working the way it should. Moving it into a low-cost index fund inside the same account, no contribution increase required, is one of the highest leverage moves available to someone who feels behind.